central bank has tried to pull inflation down from the current 40-year high. In fact, the central bank said, and you just heard it from Jerome Powell, that it would not flinch in its battle against the most intense breakout of inflation in the U.S. since the 1980s, even if that means a sustained period of economic weakness and slowing jobs market. But added that the U.S. is not in a recession right now, which was the big concern for the market. The latest rate hike follows a similarly sized increase in the month of June that you saw when the central bank officials started to become more worried about inflation. Investors anticipated another relatively large increase after the latest consumer price index showing that inflation jumped all the way to that 9.1% mark in the June quarter from the year earlier, faster than what it saw in May, and crushing hopes that prices had already peaked. So I guess that's the takeaway. But the good news is that the Fed has moved on expected lines, so no nasty surprises. And you've got the SGX Nifty holding up almost 1% in the green now. It's well above that 16,750 print.
Oh, well, yes, absolutely. And look at those big moves that we saw overnight on the Nasdaq, up around 4%. And it's pretty much what really Street wants to hear, because Jerome Powell also talked about the fact that there is possibility of a further rate hike on an aggressive path in the coming meeting as well. But that's not really what Street heard. They only heard the fact that there is some likelihood of some softening at some point of time.
They chose to not hear it.
Exactly. Let's discuss all of that with our guests as well. We have Brandt, the Director of Research at EPFR Global, as well as Rob Carnell, Head of Research and Chief Economist, Asia Pacific ING, joining us on the show. Good morning, gentlemen. Thank you so much for speaking with us. Cameron, first coming to you, what do you make of the overall commentary and the fact that the Street really chose to hear only the more dovish comments coming in from Jerome Powell, and what does it do to the rate expectations for the coming meeting?
So certainly what I've been seeing for a number of weeks on the mutual fund flow side is, strangely enough, I would say, a sense of optimism. And I think the fact that the Fed went with 75 basis points rather than the full 1% has reinforced that. Certainly all the initial commentary and conversations I've had in the wake have focused on the fact that Powell talked about the data points that the Fed will see between now and their September meeting. And I have to think that by September, some of those data points are not going to be screaming further hikes.
Right. When we just talk about how the markets reacted yesterday, especially Rob, when actually that 75 basis news came, markets were not volatile, which was not the case earlier in the last 3 or 4 Fed meetings. And then after the press conference, the market actually went up. You think markets are now, getting more mature in terms of reaction to how Fed reacts?
I'm not sure they're getting more mature in terms of how they react to the Fed. I think what they're beginning to do now is look a little bit forward and thinking, maybe there's 2 things that I think the market wants to believe. One is that we've passed the point of peak Fed hikes, and there was a hint yesterday that was the case. The suggestion that forthcoming hikes might be at a more moderate pace, that went down extremely well. And I think they're also looking for peak inflation to have passed as well. Yes, we had the 9.1 print, but if you look at the inflation expectations, they're coming down. The market believes that the Fed is going to achieve this goal of getting inflation down. And for them at this stage, that's enough. And they're sort of ignoring all the, we hear a lot of the stuff about recession. Are we in a recession now? Well, of course we're not in a recession now, Jerome, and that's not really, no one's really arguing that. The question really is, has the market ever really priced in the recession that looks as if it might have to happen? And they dance around this in their commentary about weaker growth and the labour market, which is, of course, a lagging indicator, and it's not going to drive the recession, but be a symptom of it, whether or not that's ever being priced in. And I think we still have a slight risk in the background that could start to play a greater role in the coming months.
So we do have the Fed Chair, Jerome Powell, talking about more financial tightening in the pipeline. Leaves out details of when that is going to be possible. talks about the impact of all of this on the economy. And with that, Cameron, coming to you, a pertinent point being made by Rob there. Did the markets ever fully price in the ugly R word? And is that why maybe the bond market little unchanged? And how did you figure out that the way the dollar behaved after all of this commentary?
Well, I think that the market did sort of start to price in the R for a little bit back there in certainly June coming into July. But they've, I think, sort of really skipped ahead to the fact that the R word in their mind translates into a rapid return to the highly accommodative monetary environment that it has happily gotten used to over the past decade. And certainly, I feel it's going to be very hard for the Fed to keep rates at any meaningful level the moment inflation does start to roll over. For the past 10 years, they've been fighting to get inflation above 2%, while at the same time maintaining labor market strength. Many of the critics say that their mandate has ranged too widely. I think that it's going to take quite a bit for the sort of slightly rose-colored view of the market to sort of darken, shall we say.
Okay, coming back to my
Rob
earlier...
agrees.
Sure. Point taken. Rob, let me come to you and, get back to the point that we were discussing. Now, if you go by the respondents and the survey which is out, it does suggest that people are expecting it's going to be a 50 basis point hike in the next September meeting and not really a 75 one. And there is an expectation that come 2023, in the mid of the year, we might see a bit of reversal and the rates, cutting cycle as well starting. Is this something that you concur with?
Yeah, well, I mean, I think the key thing to say, and I think Powell would reinforce this as well, is what they do next is going to be data dependent. And between now and the next FOMC meeting, we'll have 2 labour market reports, we'll have 2 inflation reports. So that will really steer what they're going to do. But I think 50, where we stand today, given everything we know, looks a more plausible outcome for the September meeting than a 75. And yeah, I would certainly think that we ought to be thinking about rate cuts through the middle part of 2023. Historically, the Fed, once it's got to its peak Fed funds, whatever that's going to be this time, we're thinking it's going to be around the 375 level, but it's usually only stayed there for about 7 months on average. I mean, that does take you to the middle of 2023 if history repeats in the way it tends to. So, and again, getting back to my point I made right at the beginning, I think this is what the market is now beginning to look forward to. It's, as Cameron pointed out, it's that sort of return to the monetary largesse, which has really juiced markets in the past and which it really wants to go back to.
Right. Rob, great to have you on the show today. Thank you so much. And Cameron, good to speak with you as always too. Let's move